Well, and again, I think that's the case. We've rallied really, really well over the last month. Some of it, the Israel-Gaza thing, but most of it is this change of financial conditions, easing of financial conditions with the dollar coming down, the stock market going up, bonds rallying. And that has bled over to this almost 10% rally in gold. I mean, gold now is, was about what, 1830 back at late September, early October, and now it's 1970 or whatever it is, and up on the year. I mean, we began the year at 1830.
In the latest market analysis, Craig Hemke explores the prospects of a gold and silver rally, spotlighting the Federal Reserve's pivotal role in shaping market dynamics. Hemke expresses skepticism regarding the Fed's commitment to higher interest rates, anticipating a potential shift to emergency measures in times of crisis. Reflecting on the year's market movements, he discusses unexpected fluctuations in precious metal prices and the divergence from earlier projections. Despite these challenges, Hemke remains optimistic about the future of gold and silver, citing easing financial conditions, a weakening economy, and potential Fed responses as factors contributing to a forthcoming rally. The discussion concludes with insights for investors, touching on considerations like mining shares, tax loss selling, and the gold-silver ratio. Like, subscribe, and turn on notifications to get more videos like this, and check our pinned comment for some massive sign-up bonuses with our official partners. Let's get into the video.
So we're back to being a typical year in gold, about 9 to 10% return. And again, you mentioned the shares too. The issue that it's struggling with, at least here in the back part of November, we saw, at least to my eye, a deliberate attempt to keep gold price down back on Friday when options were expiring on the GLD and the SLV. I'm writing about that today for Sprott Money. And pretty soon, next week, we get the front month December contracts. Those have volume and open interest all year long. And they will go off the board, and the options will expire next week. So we're probably kind of swimming against that for the next week. But once we get into December, the next jobs report will probably be weak. Seasonally, all the seasonal and birth death adjustments for November and December are weak and small. And so the next jobs report is probably going to be weak. That'll probably allow the Fed to be kind of less hawkish, a little dovish by the time they meet again in the second week of December. So I think the stage is set for a year-end rally. You mentioned the miners. Here we are again, another year where the mining shares are underperforming everything else. And so we are going to get a spate of tax loss selling. Usually that goes into about the 15th or 18th of December. People think it goes later in the year, but a lot of people want to put that stuff behind them before Christmas, not jack around. I'd get it over with. And so tax loss selling, when it happens, and like it will happen, it's usually done by about the middle of the month. So the shares will probably remain under pressure. But once you get a little bit of breakout there, the GDX gets above 30, stage be set for a rally there too.
In the continuation of the interview, Craig explains his time frame for his predictions to pan out and links everything up with the Federal Reserve rate cuts that are expected to happen in 2024 as market expectations continue to shift and surprise professionals and retails alike.
So I've been right the whole time about this. You just don't know how long it's going to take. And so when I say this year's kind of a microcosm of that, that's kind of the same thing. I mean, everything I wrote about back in January, I still believe in, and I still was, I think, right. It's just like 6 months behind schedule. It's just taking a little longer. And I don't mean that as an excuse. I'm surprised myself that the data kind of has held firm, the data that the Fed looks at. And some of it actually seemed to improve a little bit over the summer. When we got at the FOMC meeting in June, even the FOMC members were talking about rate cuts maybe as soon as December and 4 rate cuts in 2024. That's what the Fed was projecting. 5 more in 2025. And at that point, we were right on track. I thought, oh, yeah, okay, perfect. This is exactly what I've been suspecting would happen. The economy would slow down. We'd start getting rate cuts. Gold would move above, break out of its range. Tack on 10%, which things often do when they break out. And then instead, all of a sudden, the data seems to get a little bit better. And by the September FOMC meeting, not only are any hints of rate cuts gone for the remainder of this year, we start talking about rate hikes, and future rate cuts for next year get cut from 4 to 2. And, what does gold do? It goes down instead. Now it has since rallied as things have gotten softer again. And even the market, Fed funds futures, is starting to pull rate cuts forward again and starting to talk about 3 or 4 for next year. So now all of a sudden we're right back to where we were in June. It's just like we lost 5 or 6 years or 5 or 6 months that we're not going to get back, which again is what a lot of people feel like have been holding gold for the last 10 years. So I still expect the economy to continue to weaken. I expect the Fed to respond to that because that's what they've done consistently over the last 15 years since the paradigm changed, toward QE and zero bound interest rates and the like. And I think that is shown in price with a rally in the first half of the year that does what I thought the back half of this year would do. Get above 2,100, tack on 10%, and should be a good time for
gold prices experienced a slight dip on Monday, influenced by a weakened dollar that provided a price floor, while investors awaited insights from the Federal Reserve's recent meeting for clues on the central bank's interest rate trajectory. Bart Mellick, head of commodity strategies at TD Securities, noted that gold faced technical resistance, returning to range-bound trading with the catalyst of somewhat higher rates. Anticipation surrounded the Fed's commitment to maintaining elevated rates based on inflation considerations. Last week's data reignited hopes for earlier monetary easing, impacting the precious metals market. Kitco Metals analysts pointed out that rising U.S. Treasury yields were influencing gold and silver buyers despite a lower U.S. dollar. Spot silver rose 1.3% to $23.43 per ounce, while platinum and palladium also recorded gains, reaching their highest levels in about 2 weeks. The trajectory of U.S. Treasury yields and silver prices is intricately tied to expectations of Federal Reserve rate cuts in 2024. As the market navigates the prospect of lower interest rates, the appeal of silver XAUUSD intensifies, given the diminished opportunity cost associated with holding non-yielding assets. A pivotal factor influencing silver prices is the performance of the U.S. dollar. Recently, the dollar experienced a dip against major currencies, partially attributed to light trading volumes during a U.S. bank holiday. This descent, coupled with evolving expectations regarding the Federal Reserve's rate hike stance, has bolstered silver's attractiveness. The reduced cost for international investors to engage in silver positions contributes to its growing allure. Now, we'll show you the rest of the interview, but first, like, subscribe, and turn on the notifications bell to let us know you like the video, and check our pinned comment as Bybit is giving free $20 just for creating an account in their platform so you can start trading real crypto today. Let's get into the video.
Over the last 6 weeks or so, what's going on? There's a long-term relationship between real interest rates and gold. And you've probably seen the charts. People listening to us have seen the charts. They move in tandem, and all of a sudden they go like this. And by that chart, with where real interest rates are, at least in terms of inflation expectations versus the nominal rate, you would think gold would be like $1,200. It's not. It's almost 2,000. What's going on? Well, there's a number of reasons for that, but one of them is it's not fear in terms of, oh my gosh, I'm going to lose money. It's fear of missing out for that next rally when the Fed turns the spigots back on. I think it's absolutely the same is true in the stock market. I mean, back when I got my Series 7 license 33 years ago, I didn't have all these wrinkles. But back then, there was like a fundamental relationship between, prices and earnings, and you're entering a recession, so earnings are going to be falling. So therefore, if you want to keep the same PE ratio, the price is going to come down too. That's all out the window these days, brother. And I think besides the fact it's only 7 stocks that drive the S&P these days, stock prices and the indices remain elevated by fear of missing out. Not fear that, there's a 30% crash and, my 401k is going to become a 201k. Remember that old joke? It's instead, I want to make sure I'm long for when the Fed starts cutting again. And unless you switch that back to just straight up fear, it's going to be a pretty good time to, just be into general stock market too, I'd suppose. It's kind of that crack up boom kind of thing that we've talked about for decades. Same kind of phenomenon, I guess.
What do you think of today's show? Do you agree with the topic presented today, where gold and silver are ready to rumble in 2024? Post in the comments section down below if you're accumulating gold and silver at these prices, and let us know if you're positive or negative on your trade. Thanks for watching the video to the end. Subscribe to get more valuable insights from financial experts on a daily basis in the commodities landscape, and share this video with someone who hates gold. And I see you next time.